All right, let's talk about the one big beautiful bill, how it impacts your taxes. It's not a political discussion. This is just strictly looking at the effect based on what was passed. But not to pass any judgment, I believe this will create $1 trillion deficit approximately over the next 10 years. I think maybe two to three $1 trillion deficit. So if you don't know me, my name is Jeremiah Pangan. I'm an enrolled agent and have been practicing and own my tax and financial firm over the last 10 years. I serve over 1,000 clients at my local firm here in Glendale, California, and obviously nationwide if you want to work with me remotely. So the first thing is the extended tax cuts of our marginal tax rate. So if you guys didn't know, during President Trump's first term, the TCJA, Tax Cuts and Jobs Act, cut our marginal tax rate, but it had an expiration, which was this year, commonly known as the tax sunset. So if you were at the 12% tax rate, you were going to go back up to 15%. And if you were at 22%, you were going to go back up to 25%. If you are 24%, you were going to go back up to 28%. This time, the cut to the marginal tax rate has been made permanent. So currently there's no tax sunset. 2 is the enhanced standard deduction. So the government gives us a standard deduction. So in 2025, if you're single, it's roughly $15,000. So that means you don't pay taxes on your first $15,000. Before President Trump, this was at $6,350 plus a personal exemption of $4,050, which is basically $10,400. If you're married filing jointly with your spouse, of course, doubled, but they allow you to have a higher standard deduction now with the OBBB with a lower tax rate, right? Which should result in having more money in your pocket, right? That's the second thing. Number 3, 90% of Social Security beneficiaries will not pay tax on their Social Security income. So if you don't know, if you're retired, if your income is only Social Security, you don't pay taxes on your Social Security income benefit. However, if you're collecting a Social Security income, your benefits become taxable. Up to 85% of your benefits can be taxable. There's also an additional senior bonus deduction of $6,000 for anyone who's 65 and up, and it's doubled obviously if it's a married couple. Number 4, right? Let's talk about the child tax credit. It is now up to $2,200, and the refundable is capped at $1,400. Before the one big beautiful bill, the refundable is only up to $1,000, and then before President Trump's first term, the child tax credit was only $1,000. And then they added this credit, which is called the other dependent credit, which is $500 for any dependent that you have who's over 17 years old. And this will stay permanent. This didn't exist before as well. So that's number 4. Number 5 is, and I think, this really benefits all the first-time home buyers that didn't put in the 20% down payment, right? Your PMI or your mortgage insurance premiums are deductible again, and it's made permanent. So if you have a FHA loan, you made less than 20% down payment to your first home, this should benefit you. I really love this part of the bill. I really love this part of the bill. Now, number 6, there's an expansion on the educator expenses where most teachers before can only take an above-the-line deduction of $300 and $600 if married. Now, there's a new unlimited deduction for unreimbursed educator expenses. And here's the good thing about it. They expanded the definition of educator, which now includes coaches. So I know a lot of my teacher clients spend more than the $300 in their classrooms, right? So now there's an expanded educator expenses that you're able to write off. I don't know much of the specifics of that yet. I'm still waiting for it. but I saw this as part of the bill. Here's number 7, right? Number 7 is the state and local tax cap is now up to 40,000 versus the 10,000. A lot of my clients will benefit from this. Actually, I'm going to personally benefit from this because in one of our properties, our property tax alone is over $11,000, right? So now this includes your state taxes again as a deduction, and this could result in a higher refund, or, you pay less overall tax to the federal. Now, this phases out in 2029, so we have a couple of years to enjoy it. For Trump, before the Tax Cuts and Jobs Act, we actually had there was no cap at all on state and local tax. When he implemented this during his first term, it was a way for the federal government to take money from people from higher state taxes. That's just my opinion because a lot of my clients were affected by this, and we live in a very high state tax. So California taxes plus all the property taxes, we used to get higher refunds or pay less taxes because we were deducting our state income tax and then obviously our property taxes, which adds up to, the cap of $40,000. So this is very nice. We're going to get more money back from the federal government, right? That was taken away from us for the one big beautiful bill. 8 is, I think everybody was talking about this, no tax on tips, right? This is actually a deduction. It's not an exclusion. So it's a little bit misleading, right? It's not necessarily an exclusion of income on all of your tips. It's actually just a deduction. So you're allowed to deduct up to $25,000 per year, and it will be through 2025 through 2028. I believe there was a part in the code, right, that it needs to be voluntary. So if you go in big groups, right, at a restaurant and they have mandatory tips, right, you know how when you go for a party of 5 or more, those will be excluded because the restaurant is setting the tip, right, and it's not voluntary that you're paying. So it's basically because the restaurant set that because there's a party of 5 or 10 or more, those do not qualify into the no tax on tips as a deduction. Number 9, no tax on overtime, which is, like I said, it's a bit misleading. It's a deduction, not an exclusion. The deduction is up to $12,500 per year. It's doubled if you're married. Your employer will include this on the W-2 that you receive at the end of the year, right? So those are, pretty cool, the last 2 deductions. And then number 10, right? This is something that's new. You now have a car loan interest deduction of up to $10,000 per year. This is allowed for personal use. This is not a new deduction for business owners, but if you have a personal vehicle, this is something that, you could now take advantage. And this is for all loans that is secured after December 31st, 2024. And guess what? Even if you don't own a home or you don't have an itemized deduction, you're allowed to take advantage of this. At least right now, at this time of this filming, that's what I know. So this is allowed even if you're not itemizing. Number 11 is the Trump accounts of $1,000. So for babies born after 2024 to 2029, I know most of you guys are familiar with the 529 plans. I believe this is called the 530 plans. It's a pilot program. I think it's a benefit because it will encourage saving money. I'm not a big proponent of 529 plans. I don't know what the specifics of this, but this is part of the bill and I wanted to cover it. Dependent care tax credits. The daycare, right, they are now refundable. So if you don't pay any taxes, if you don't have any tax liability, you can get some of it back now. So I think this applies more to people that are self-employed, right? They don't have that much withholdings. Now, it wouldn't just reduce your total tax. You can actually get some of your money back. Number 13, there's an above-the-line charitable deduction now of up to $1,000. Before, only homeowners that do itemized deduction can really take advantage of a charitable contribution deduction. I believe they implemented this during the COVID era as well, but it was limited to a couple $100. Now it's $1,000 if you're single. and it's $2,000 if you're married. I know a lot of non-homeowners, who go to church, they make little contributions here and there, and it doesn't make a difference in their taxes, but now you can write off up to $1,000. You can now benefit from the deduction. The student loan repayment assistance, number 14. This was going to expire this year, but was made permanent. Your employers can contribute to repayment of your student loan of up to $5,000 per year, tax-free. So if your employer makes a contribution, you don't have to pay taxes on that extra $5,000 that your employer paid you as an employee. Now, this is not a benefit. I just want to throw it out there, but electric vehicle credits are going away, right? Solar panels for your home and any energy efficient improvements you do on your home will be going away. So if you want an EV credit, you have to purchase your car before September 30th of 2025, right? And you have to get your solar panels before the year end in order for you to take advantage of the 30% credit for putting a solar panel in your home. So hopefully this helped you guys. These are a couple of things that I thought would impact you immediately. And thanks for watching. If you guys have any questions, just shoot me a DM or drop it on the comments below. Thank you guys.